powering the Bitcoin economy sometimes means buying Bitcoin and raising capital via equity or credit issuance to buy Bitcoin. But the best thing is a very healthy digital equity. So MSTR, MNAV expanding, and then very healthy digital credit, low volatility, high liquidity, high performance, stable credit. And so we're always thinking about those things. I expect that Bitcoin price will go up forever. And if Bitcoin price goes up forever, you could buy it forever, getting exponentially less as the price goes exponentially higher, right? And that would be good for the entire economy. I mean, for the entire crypto ecosystem. But we don't have any hard target one way or the other, and it all comes down to the equity capital markets and the credit markets.
Perhaps the most revealing part of the discussion is how Strategy manages its balance sheet and financial operations. Saylor says the company's mission is incredibly simple: increase Bitcoin per share forever. Everything the company does revolves around that single objective, but how they achieve it is highly sophisticated. According to Saylor, Strategy constantly evaluates 4 different financial tools: cash, equity issuance, credit issuance, Bitcoin sales. Rather than relying on only one method, the company uses a combination of all 4 depending on market conditions. Saylor explains that Strategy has run extensive multivariate financial models, and every model showed the same result. A diversified capital strategy consistently outperforms a strategy relying only on debt, only on equity, or only on Bitcoin. This is why the company remains flexible. Sometimes issuing equity is optimal. Sometimes issuing debt is smarter. Sometimes preserving cash makes sense. And occasionally, even selling Bitcoin may become strategically beneficial. What matters is maximizing long-term Bitcoin per share 7 years into the future. That's the key metric driving every decision. Remarkably, Saylor says many of these decisions happen continuously through algorithmic systems that monitor markets in real time. Some trading and treasury decisions are made minute by minute, and sometimes even second by second. This reveals how deeply Strategy has evolved into a financial technology company built around Bitcoin optimization.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Bitcoin is its own asset, and it's driven by geopolitical capital flows. So, for example, Chinese crypto investors, Asians, South Americans, Africans, Europeans, they all have their own capital flow dynamics. And so an edict coming out of India, Pakistan, China, Iran, Russia, or Ukraine could drive Bitcoin flows having nothing to do with the US equity capital markets. It's right now the headwinds that it faces are rising interest rates on the high end of the yield curve everywhere in the world. And that is drawing capital out of this ecosystem. It's also facing the headwinds of AI. There's a lot of capital flowing into the AI trade right now, and that has drawn capital out of Bitcoin from on the investor side. And also, if you're watching the miners, a lot of the Bitcoin miners have been diversifying or transitioning into doing AI high-powered compute, and they're selling Bitcoin or they're not holding Bitcoin in order to fund their transition. So that's a bit of a headwind. I think that the trade wars are a headwind. I think the hot wars are a headwind. And I think the lack of the rollout of bank credit networks, which is evolving, but it still has not taken place yet. Those are all headwinds. And if you look at the equity capital markets, the equity markets aren't influenced by the lack of credit from JP Morgan. They have a lot of it. The equity markets are being driven by the AI trade. They're benefiting from it. The equity markets, they don't have the drag of China crypto policy, which has an impact on Bitcoin, but not on equity capital markets. And so equity capital's got its own dynamic, metallic capital, gold has its own dynamic, digital capital has its own dynamic, and you just kind of have to humbly make your peace with them. They're different asset classes. They're not always going to correlate in lockstep, and you don't want them to correlate. They're different things for different investors with different degrees of utility. I think we enjoy keeping everybody guessing. It definitely makes X a lot more interesting. Our view is business as usual here. We're kind of matter of fact about this. The goal of the company is to drive Bitcoin per share and to increase its Bitcoin and increase the enterprise value continuously forever. We'll make decisions about how we fund our liabilities week by week, day by day. Sometimes we make them minute by minute, to tell you the truth. We set algorithms where we're looking at what is most long-term advantageous to the company. Are we managing our credit risk? Are we creating Bitcoin per share? And are we best off to pay a liability with cash, or to pay a liability by issuing equity, or to pay a liability by issuing credit, or to pay a liability by selling Bitcoin? We've done a lot of multivariate models, and in all the models, what we find over the long term is that by far the best thing for the company is to engage in a mixture of those four instruments. Any model that we put together that's limited only to equity or only to credit or only to Bitcoin always underperforms. So ultimately, the way to think of it is 7 years out, we would like to have maximized our Bitcoin per share. And what is it that we should be doing now that's going to maximize and optimize the company's performance so that we've maxed out Bitcoin per share 7 years from now? And I think it's not unlikely that we'll sell some Bitcoin between now and the end of the year. I don't know how much. We still consider these things. But it's also likely that we'll sell a mixture of equity, a mixture of credit. We'll manage our USD, our cash positions, and we do it in a very thoughtful, programmatic fashion where we're running our multivariate models, and we're literally running them. We're making trading decisions. To say every minute might be an understatement. We oftentimes make trading decisions every second, and we'll continue to do that. Empowering the Bitcoin economy sometimes means buying Bitcoin and raising capital via equity or credit issuance to buy Bitcoin. But the best thing is a very healthy digital equity. So MSTR, MNAV expanding, and then very healthy digital credit, low volatility, high liquidity, high performance, stable credit. And so we're always thinking about those things. I expect that Bitcoin price will go up forever. And if Bitcoin price goes up forever, you could buy it forever, getting exponentially less as the price goes exponentially higher, right? And that would be good for the entire economy. For the entire crypto ecosystem. But we don't have any hard target one way or the other, and it all comes down to the equity capital markets and the credit markets.
One of the major points Saylor makes is that Bitcoin operates independently from traditional equity markets. Many investors still compare Bitcoin to tech stocks or treat it like a high-risk NASDAQ asset. But Saylor argues that this comparison misses the bigger picture entirely. According to him, Bitcoin has become its own asset class with its own global capital dynamics. Unlike stocks, Bitcoin is influenced by geopolitical events happening all over the world. Capital flows from Asia, South America, Africa, Europe, and the Middle East all affect Bitcoin differently. An announcement from China, India, Russia, Iran, or even Ukraine can instantly impact Bitcoin markets, regardless of what's happening in the United States stock market. That's because Bitcoin exists outside the boundaries of any one national economy. Saylor explains that traditional equity markets are largely driven by corporate earnings, domestic credit systems, and investor sentiment around sectors like artificial intelligence. Bitcoin, on the other hand, responds to a completely different set of forces. This distinction is critical because many investors expect Bitcoin and equities to move together in perfect correlation. Saylor believes that assumption is fundamentally flawed. Different asset classes serve different purposes. Gold behaves differently from equities. Real estate behaves differently from bonds, and digital capital behaves differently from all of them. According to Saylor, investors need to make peace with the fact that these assets will not always move in lockstep.
I'm really excited and impressed by what Strive has accomplished. I'm thrilled to see them bringing a daily dividend digital credit instrument to market. I'm also impressed at how rapidly they did it. I think it's quite an extraordinary thing for the space. I believe it's actually great for them. It's great for the digital credit space. It's great for Bitcoin. It's great for us that they're able to bring that instrument to market. It's obviously working very, very well right now. They've been sitting around par for the last week or so, and so that it's working in the market. I don't feel like we need to steal their thunder. I actually wouldn't mind seeing them get 10x bigger than they are right now, as they actually use SATA as the engine to drive growth at Strive. And I think we're all in a cooperative relationship there. We're a Delaware company, they're a Nevada company. We have different corporate governance requirements than they have. We're also 100x bigger in terms of scale. And so I think it behooves us to move forward deliberately. And right now for us, going from monthly to semi-monthly is a bold and I think a very progressive step. I think that will play out over the course of the next 4 weeks. We have a shareholder vote coming up in early June. I think that will dramatically improve the performance of STRC. Once we've gotten to semi-monthly, then I think the market will have a daily credit instrument from Strive and a semi-monthly credit instrument from Strategy. I think it's quite possible that the market will benefit by having the two different frequencies. I'm humble enough to know what I don't know, and I'm looking forward to seeing how the market trades STRC, how it trades SATA. If both of them reach their full potential, that's great. We'll watch that performance, and over time, if it turns out that there's overwhelming demand from our own shareholders to go to daily, then that's something we'll consider. But I don't really think that we need to copy what they've done. I almost would rather have them be the only instrument in the world doing that, because that's insanely good publicity for them, insanely good publicity for digital credit. And for those people that absolutely need that, that's going to be a great market expanding innovation. That we like where it is right now, 11.5% seems to be working very, very well in the marketplace. We're not, we think of this as we're kind of piloting, an aircraft carrier or a cruise liner, and it takes a while to change direction. Once you get it up and running and there's a certain amount of momentum, you prefer to just leave it that way. So we're not anxious to over control the vehicle one way or the other. And I think we think over 20 years that the dividend will gradually be lower. But we're thinking in terms of 20 years, not 20 months. And ultimately, the dividend rate for STRC will be driven by the health and the growth of the crypto economy, and specifically the Bitcoin economy. So we'll manage this in order to create our goal. We want to minimize volatility. We want to minimize uncertainty. We want to maximize the growth in the credit instrument so that we can maximize our acquisition of Bitcoin, so we can maximize Bitcoin per share. And all things being considered, we would rather do something which is low volatility, stable, enthusiastically embraced, and pay 11.5% than save a few basis points and pay a little bit less, but create uncertainty, anxiety, or instability in the marketplace. And so I don't think we presently expect a change in that dividend policy, but we have to look at the performance of the credit, the 1-month VWAP, the strength of the credit, the strength of the underlying Bitcoin economy, the volatility of Bitcoin, and people's views toward digital credit, digital capital, etc., and make the responsible adjustment from time to time if we needed to. We have a legal obligation per the security itself, but it is the company's #1 business objective. So the way to understand it is we have about an $80 billion enterprise. And if you were to ask, what is the #1 thing that we want to ensure month by month, quarter by quarter? We want to ensure the stability of STRC around $100. If STRC doesn't hit the $100 peg each month, then the company is going to take action in order to strengthen it. And we've shown ourselves one to do it. We raised the dividend, was it 6 times in a row, or 5? How many times? We raised the dividend multiple times. We raised billions of dollars of capital and bought Bitcoin with it. We raised billions of dollars of capital and we put in a US dollar reserve. We have just bought back $1.5 billion of debt, which is senior to STRC. So we will restructure the capital structure. We will raise capital. We will adjust the dividend. We went and put a presentation or a proposal in front of our shareholders to double the frequency of the dividend. So all of those things I just named are all in pursuit of stability around the $100 target. So you can think of it as a business objective, and you could almost view it as that's the reason that the company is here. Like that is the primary KPI for strategy, is to stabilize and make the digital credit successful. And I would contrast that to, we're not terribly concerned about the price of a convertible bond trading in the OTC market. And if you were to ask, how do we feel about the price of STRD, STRF, STRK, STRE? Well, we'd like them all to be higher, but we don't get up every week and every morning and obsess over what we need to do in order to deal with those securities' performance in the market. Or in the near term, MSTR is going to move around. The primary flagship security of the company is STRC, and the primary objective is to strip the volatility and stabilize the instrument at par.
One of the boldest statements Saylor makes is his belief that Bitcoin's price will rise forever. Not temporarily, not cyclically, forever. His reasoning is based on scarcity and global adoption. As more institutions, governments, corporations, and investors seek a scarce digital store of value, Bitcoin's fixed supply becomes increasingly valuable. Saylor argues that even as Bitcoin becomes exponentially more expensive, people will continue buying smaller fractions of it. This mirrors how investors buy fractions of gold, real estate, or equities today. For Saylor, this creates a self-reinforcing ecosystem where strong digital credit fuels capital formation enables Bitcoin acquisition, Bitcoin appreciation strengthens balance sheets, stronger balance sheets support more digital credit growth. It's essentially a continuously expanding digital capital engine, and strategy intends to sit at the center of it.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.